Estimation of insurance deductible demand under endogenous premium rates. Government subsidized insurance is ubiquitous, yet estimation of demand in such markets remain challenging. The premium charged for a given deductible is determined by actuarial construction, thus observed choice pairs are endogenous leading to biased estimation under standard econometric approaches. A theoretical model and stimulation study are developed and a new identification strategy proposed. An empirical application using federal crop insurance program, a $100 billion per year program, data reveals that demand is quite elastic after accounting for this endogeneity. Mistreatment of such endogeneity is likely partly responsible for pervasive faulty finding on inelastic insurance demand in related application. Policy implications are also discussed. Government subsidization of insurance is commonplace in many insurance markets, including health, flood, terrorism, deposit, agriculture, among others, and comes in both supply and demand enhancing from including explicit premium subsidies, mandatory coverage, and favorable government reinsurance. The analysis of consumer responses to subsidization is central to evaluating, budgeting, and designing these programs. Such interventions are often argued on the premise that they either complete a missing market and or reduce some externality to society, though there are many arguments against such intervention as well. Often, the large administrative databases maintained by the government on actual purchases are the primary source of data for evaluating and predicting market responses to change in policy or subsidy rates. Understanding how to answer such questions using transactional data is thus of great importance but presents challenges related to endogeneity and complexity of product and program structures. In the United States, the Federal Crop Insurance Program, or FCIP, is a foundational agricultural support program with around $100 billion in liabilities annually. In fact, the FCIP is the largest direct agricultural subsidy program in the United States and the single largest agricultural insurance program globally and historically. Internationally, subsidized agriculture insurance has also gained a foothold as a preferred mode of intervention to complete missing risk management markets in the presence of systemic risk, including large programs in China, India, and in many African countries. Having sound demand elasticity estimate is of utmost policy importance. For example, the U.S. Government Accountability Office or GAO recently released a report that concluded, based on elasticity estimate in the literature, that demand for crop insurance in the United States is inelastic, and then subsequently inferred that subsidization could be cut and insured paid rates increased substantially without significantly affecting program participation. However, the findings in the literature cited in the report are somewhat puzzling prima facie, given the large uptake in the last decades observed in the FCIP in response to increased subsidization. The price of insurance, premium rate for a given deductible, quantity, or coverage level chosen by the insured is determined according to a convex actuarial premium menu, typically referred to as the rate curve. Insurance coverage quantities and prices in observed data are ultimately generated from such actuarial schedules, and thus observed data are endogenously determined. We show that when multiple deductible levels are available, the near universal approach of estimating demand elasticities with observed coverage on premium rates via ordinary least squares or OLS will thus result in severely biased demand elasticities. This fundamental specification aspect regarding the endogeneity of the premium schedule in deductible level has received no treatment in the economic literature on insurance demand. To our knowledge, no cohesive strategy has been developed or theoretical or econometric basis articulated to address this despite the broad appeal in a wide universe of insurance markets. Premium rate endogeneity consideration have been found to be important in related contexts though. For example, Weiss, Tennyson, and Regan 2010 find that accounting for rate endogeneity resulting from regulation can have profound empirical impacts when evaluating incentive distortion in insurance markets but do not deal with the more fundamental issue at stake related to the fact that fair premium rates vary in response systematically to the deductible purchase as a matter of actuarial construction. The purpose of this study is to investigate the estimation of insurance deductible demand with an eye toward identification issues arising from the simultaneous determination of observed rates or deductibles. The existing literature is extended in several ways. First, we derive a theoretical model of insurance deductible demand under an endogenous rate curve that departs from the standard full insurance result. An estimable model of insurance demand is then derived under an endogenous actuarial rate curve and evaluated from an econometric perspective. An estimation strategy is proposed and investigated that involve instrumenting with specific information inward from the premium rate curve. A simulation study is conducted to investigate the econometric properties of this estimation phenomenon and confirm the performance of the proposed approach. An empirical application is then investigated using program insurance data from the FCIP for a major market to estimate the magnitude of this effect in actual data. Consistent with the large growth in insurance uptake in response to increased subsidization through time in the FCIP, the theoretical, numerical, and empirical finding uncovered here suggest that demand for this insurance may in fact be orders of magnitude more elastic than previously thought once properly accounting for this endogeneity. Several models and measures are investigated that consistently find that insurance coverage demand is elastic to premium rate, as is the total liability per insured acre. The result indicate that accounting for this effect typically leads to demand elasticities that are consistently 3 until 5 times greater than under the standard approach. Treatment of this endogeneity may be responsible for much of the long-standing conventional wisdom regarding inelastic insurance demand in many related markets and applications. The finding and approach are valid under adverse selection and moral hazard or not, as the endogeneity issue in this problem arises directly from the actuarial construction of the rate curve. The schedule of deductible or rates, which is always upward sloping and convex due to basic laws of probability. To our knowledge, there are no other works in the literature that propose or investigate this approach to solving this endogeneity problem when estimating deductible demand in such markets. Questions related to the performance of government intervention in insurance markets and estimation issues for insurance demand more generally have received much attention in the recent literature in a variety of domains. Thank you.